Hey everybody, it's Pete. Welcome to Stocks for Breakfast. We're going to jump right into. We're going to actually set the pace for the stock market for the entire week. We are expecting some pretty big volatility this week. Last week, the stock market was closed half a day on Wednesday. Closed obviously for Independence Day. Gave everybody a chance to kind of wind down. Wake up! We're going to have some volatility. We have inflation data this week, and we have earnings season kicking off with the financials. But I want to start out with something actually that is a little bit different, which is something that we talk about a lot on this channel, which I really hope you write down, is we're looking for clues. We're not looking for answers. I think a lot of stock traders are mistakenly believing that the one thing that they find is the one reason that they should be looking to be involved buying and selling stocks. But it's really not that simple. What we want to do is we want to build multiple reasons. If you could kind of visualize a pro list and a con list of all the reasons you would want to buy it, all the reasons you should not be looking to buy the stock, and then kind of add that up. And that's kind of what increases or decreases your conviction in whichever stocks you find are the best stocks to buy now. Now, when you kind of add that up together, there's some really amazing reasons to buy stocks. And then there's some other ideas that you can just kind of justify, but not exactly at the top of your list. And I'm actually going to show you a bunch of those examples today. But here's the important thing. And this is actually something that we had spoken about in a really big way on our private coaching sessions, which is all of that stuff that we do to determine how much conviction we have in the market, in the sectors and sector rotation, industry groups, and ultimately up to that stock pick. All of that, building that argument should instantly move into what does that mean for the kind of risk you're willing to take on that idea. And I think most stock traders, especially new ones, just don't really give enough thought to the fact that a lot of ideas are different, and difference in those ideas requires different position size. So I want to kind of wake you up right now because I'm really jazzed up to trade this week. I don't day trade as much as I used to. However, this is one of those weeks where I think that there's going to be a massive amount of money changing hands this week, both into the market and out of the market. And I'm going to explain what I mean by that in just a second. So you need to be prepared. One thing that is probably not discussed enough as well in the stock market is that it's not a smooth, we're just going to make money every single day and that kind of thing. There are certain pockets of opportunity where better opportunity is there, and you need to take advantage of it. And then like last week, where even though the stock market made new all-time highs, which we could kind of get started on that out of the gate, there's certain things that we're paying attention to kind of under the hood. Now, if you're watching the videos that we've done recently, you know that when a stock or the market kind of goes into a box, we kind of say that that's the right price, which you can actually see here in the S&P. We basically went into a box after a nice move up, continuing to move higher on fresh economic data that is kind of just okay. Nothing shocking the system. We're going to outline what's going on this Thursday with economic data, which is going to inflect inflation. But here's the biggest thing. Now, again, remember what I say about we're looking for clues, we're not looking for answers. So when we start to build those clues, it's going to influence trade management. Trade management from the sense of building into a position, and trade management, how we're going to manage something that's going in our favor and dictate whether or not we're going to be adding to that position or getting a little bit more aggressive by moving up trailing stop losses. So actually, Simon's actually bringing up a good one. So Simon, always great to see you here today. This is actually one of them. We're actually going to break down energy and the energy stocks and point out the difference between stocks that are relative strength or showing buying pressure while the sector is still weak versus the first time a stock might be turning up and what that means for position size. So in other words, if a stock is already going up, it's showing buying pressure, and we could find a spot to piggyback on that because it's already moving in that direction. So for example, we could look at a stock such as FANG, or we can take a look at a stock such as LNG. So you can see in the energy sector, both of those stocks have established what we call stacked order flow. So if you happen to be new to the community here on YouTube, one of the things that I do and provide to the community every day is basically I'm breaking down sector momentum. And you can actually see certain pockets of opportunity where it's a little bit more obvious, where the money is flowing is obvious. It's just a question of the depth. So you can actually get a picture over here of how energy was super strong for a period of time, basic materials, while communication services did nothing. That's kind of working its way, and now you can actually see how the money's just flowing, and we're just following it, right? But I want to fast forward over to right now, which is kind of what Simon's actually talking about here with energy and SLB. And I want to compare the fact that energy has been rallying a little bit recently, not to the point where we're getting aggressive, but I want to break down those couple of kinds of ideas. But if we could really just start out with, Simon, we're actually going to come back to that. Hey, Joseph, good morning. How's it going, pal? Great to see you here today, always. Should you be buying or selling the stock market this week? That's really the kind of clues that we're looking to put together. So the first thing and the big thing that's going on is earnings season was kicked off in April by the financials. Same thing right now. You can see here on Friday. We do have some earnings coming out on Thursday, but it's really the financials heavily influenced by interest rates, which we're going to actually get into, which comes out on Thursday. So here's the deal. I want to hit you with something that should make you think a little bit deeper, and it's going to go back into that research. So we need to be thinking about, how could we add to the argument? How can we pile more clues into the thought process of, I want to be a buyer and I want to be a buyer aggressively, versus what would I need to see to say, maybe I want to be a buyer, but not as aggressively. So I want to be clear about this. If you're struggling to find your footing and struggling to find profitability, we're going to use the two stocks that I just showed you, plus the one that Simon just put in there, to give you thought process so that it influences initial position size. Now, you could build up to a bigger position size. We call that profit maximizer. It's a part of the profit maximizer, and you want to get position concentration, bigger size, only after a stock proves itself, which is very, very different from dollar cost averaging. Dollar cost averaging is, let's say that you're talking about your long-term portfolio, your 401k, your IRA, whatever it happens to be, and you're not touching the money for 20 years. As the stock market pulls back a little bit, it probably makes sense. Again, I'm not a financial analyst. I'm not a financial advisor. Everything we do is for educational purposes. But averaging into a position as it's going down, dollar cost averaging is a very long-term scenario. That's not what I do. What I do is I look to build as stuff is moving into my favor, but starting the position out with a very specific size. So in other words, do I like it and I'm going to put 5% of my portfolio into the idea, or is it just okay and I'm going to start the position because of some reasons with maybe 1% of my portfolio? So I'm going to give you just two examples. Again, these are examples, right? So the first one we're obviously going to go over is the one that I just talked about before, which was LNG, or even in FANG, right? So both of these are in short-term, last 3 weeks, what we call bullish stacked order flow. We kind of pointed that out over here, right? So you can actually see that energy is starting to kind of turn the corner, right? Now, those particular ideas are showing relative strength to the energy sector, which did not break out. So if I was looking to be a buyer in any particular sector right now, and specifically energy, those would be the first stocks that I'd be looking to get involved with. And if I was, my conviction level would be going up a little bit higher, because not only are they showing bullish stacked order flow, which basically means institutional buying pressure, the big money buying pressure, we could take a look at something like SLB, which has not quite started a rally and is currently in a box. Now, I could definitely justify what Simon is looking at and saying this would be the start of a potential move. But if you can very quickly take a look at what SLB is doing and what FANG is doing, and even more specifically what LNG is doing, is what we are doing is we are qualifying ideas to tell us, because of this and because of this and because of this, that means this much initial position size, with the plan to work our way into those ideas. So if you take nothing out of today's video, it's critical for your long-term success in the stock market is to first qualify the idea. And again, that starts out with, what's the market doing? Which sectors are doing the same thing as the market? If the market's in a downtrend, which sectors are bullish if you like to be a buyer? So market, sector, industry group, and then you look for individual stocks. But then the individual stocks still need to be at what we call the optimal entry. And the optimal entry is nothing more than something we kind of reverse engineer, as we say, what does this stock normally do when it rallies, and how much of that has just recently happened? So for example, if we could take a look at Tesla. Tesla is well beyond what we would call an optimal entry. Congratulations if you happen to buy this short-term breakout over here, but that would not be a stock I'd be looking to buy today, because what it normally does, most of it and more has recently been used. So I'm going to quote somebody, a guy named Mark Sperling, who I traded with in New York City for a while. He said, break-even trades make break-even traders. So that, again, that means that our job, after we put all of those reasons into deciding if we want to be a buyer, then the very last step is we need to make sure that the risk reward for that initial trade makes sense. And I'll tell you how you know that you're not doing that right now. Raise your hand if you put a position on it and it feels like every time you put that position on it, it moves against you. You get stopped out, you're a good disciplined trader, and then it does what you thought it was supposed to do. That simply means that you're not aware of what the stock normally does, which we call the average true move, and the fact that you're buying it a little bit too late. Now, you could contrast that with some of the other ideas that we've already discussed, where they pushed and paused. That pause is where we reset the risk reward in the direction of that buying pressure, which we call order flow, bullish stacked order flow. We get a lot of questions about what is order flow, right? If you don't know, I actually had a trading firm in New York City. We had roughly 300 traders at the time. Way back in 2007 to 2009, the New York Stock Exchange changed all of the executions, where a lot of them are now electronic, and the specialists weren't necessarily needed anymore in the same way that they were before. So a lot of them came off the floor. I was grateful enough and lucky enough to have about 25 of them, brokers, floor clerks, specialists, and even some NASDAQ market makers come trade into my office. At that time, I was trading mostly NASDAQ. They came off, and especially the guys from the New York Stock Exchange, guys and girls, there was women as well, who showed us what order flow was. Order flow is basically when institutions who have the deep pockets and teams of research analysts decide to start building a position in a stock. Now, we actually have an example of that today, because usually what happens is it takes time. So we're going to show you two examples. One of them where there's a slow accumulation happening in a stock, and you can see volume spikes. And those volume spikes during the pause is where accumulation happens. And typically, until that breaks out, you be patient. But when it does, you need to hop on board, but you need to find it first. The second one, as John Napolitano talks about, who's our options expert, which is he was an institutional trader, traded, he was at a fund that, he was the head trader at a fund that had $42 billion. And he essentially walked us through how institutions, when they need to fill an order, if they cannot anymore, they need to raise their bid and then raise their bid and then raise their bid. So when we're actually looking at charts, the smart way to be looking at charts is to be looking for allocation of money by the institutions and not simply looking at chart patterns. It's just an infinitely easier way to trade, because what we are doing, we are essentially shadowing the institutions and not necessarily predicting what's going to happen next. So when we do the research and we're actually shadowing them, we are literally looking for the flow of those institutional orders in and out of the market. Now, certain times they start to get a little bit more aggressive, and the concentration in that particular sector is higher. So you start to see the money flowing in and you start to see the money flowing out. The only thing you need to do after that is learn how to spot entries that make the most sense from a risk reward perspective. So if you're finding it hard right now to find good entries or maximize what you earn, you just need to think through these steps. It's not, again, it's not that complicated. We just spent 10 minutes talking about it. Rewind the video, take notes, and then come back. If you have any questions after you watch this video, leave comments specifically about the strategy I'm talking about right now, and I'll make sure I get back to you as soon as I can. If you want to do this with me, we have a 14-day coaching accelerator. You can learn about that in the link below, and you'll see all of this stuff, how I do it behind the scenes. So the main point that I want to get, so now we're building an argument, right? So if we could just take a look at what's going on in the market, does this look like a screaming bullish market? Now I want to give you something to compare it to, right? If we just go up a little bit more, look at this particular period of time, which was May, and look at how deep the green is and how much of the green is across the board. You can actually see here, this was that April move to the downside, and you can actually see where the selling was a little bit heavier. And then you can go out until a little bit earlier in the year where you can see much, much more green. So you can actually see the pockets of opportunity, and more specifically, let's keep going back to energy and even basic materials. where trading is just infinitely easier when you are shadowing what the institutions are doing and you are tracking the level of their commitment into the stocks within that sector. So really all we're doing is we're shadowing them. And when they buy and they buy aggressively, we're joining them. When we start to see that they are lightening up, which you can see over here, it goes from dark to green. It kind of gives you clues that things are changing. Now, that's one part of the equation. So just think about the market right now and the S&P 500 making new all-time highs, and look at what's going on in all of the sectors underneath the hood. Now, I think everybody can clearly understand that there's a small group of stocks that are heavily weighted right now in the S&P 500, which are the large cap NASDAQ stocks that are all AI stocks, right? You can actually see here Microsoft, NVIDIA, Apple, Google, Amazon, all still punching higher. But you can see the rest of the market, pretty much 80 to 90% of the rest of the market is either red or neutral. So that means that, again, while we're looking for these clues, we need to say how much of the market is just those stocks and how much of the market is not showing good breadth. Breadth basically means how many stocks are doing the same thing. So again, we're looking for clues. We're not looking for answers. We're looking to say, and because of this reason, and because of this reason, I want to be a buyer, but that reason might make me not want to be as aggressive. So now I'm going to walk you over to, again, should we be buying or selling the market right now? I want to be super clear about this. I am still a buyer, but less aggressive. Now, I want to show you something else that I think will kind of like really give you a different perspective, right? So if we continue to walk over into our data and we take a look at what the market has looked like, these are the market internals, so to speak. That's what they're known as. We have the advanced decline difference. We have the new high-low difference. And a custom metric that we put together is the difference between new 20-day highs and new 20-day lows. And that's the one that's all the way on the right-hand side over here. So take a look at what the market has done basically for the last 4 to 5 weeks from an internal perspective. How does that look? Just without even putting, like, take off the table, you might own 12 stocks or whatever it happens to be. Is that the picture of, wow, I really want to be involved and I want to be aggressive? Look at how much green is on there. The answer is no. Okay. Now I want to give you something to compare it to just basically get an idea. Look at how much different the market is looking at. And this is February into March when the market was exploding. Look at the difference in the 20-day high-low and the high-low difference of 52-week highs versus where we are right now. So I want to be clear, and I'm going to walk you through my daily research for the day just to kind of give you some clues, right? So now we need to add to the equation of what else is happening this week and how does that play into my aggressive level. So what we basically just did is we got a lukewarm reception from sector rotation over the last month or so and from the market internals. But we can't fight the fact that the market's still going up, right? Obviously, the NASDAQ hit new all-time highs. The S&P 500 hit all-time highs. So you can't fight the trend. The trend is your friend until the end when it bends. So it's still valid. Now, this is where a lot of traders kind of mess up. And I want to say good morning to Shay. Shay, good morning. How are you today? Good to see you here. And Andrew, always a pleasure, Andrew. Thanks for being here with us. So as we're looking at the market going up, what we are essentially saying is it's not a question of whether or not we're buyers. That's the smarter play right now, right? However, what we are now talking about is the aggressiveness for which we are buyers, the aggressiveness for which we are adding, and the aggressiveness for which we might be moving up our trailing stop loss to lock in some of the profits. So we've already talked about the market and financial stocks coming out this week. JP Morgan, Citigroup, Wells Fargo, all of them are scheduled to report earnings on Friday. Now we kind of add something else into the mix right now, which is the inflation data. I want to walk you through what I wrote this morning because it's kind of important to put all these pieces together. And I'll kind of work this in here for you. All right, so the overview of today's themes, right? Be ready to trade this week. The holiday is over. If you were in my office in New York City, we'd be mixing it up. We'd be all excited. Holiday's gone, volume coming back. Let's go get it, right? All eyes on the start of earnings season with the financials kicking things off on Friday. So we already know that if we have any trades in the banks, especially, which have been strong, as well as asset management companies, we need to know this is happening. Okay. And I want to give you a little bit of a heads up. We get this question all the time, and it's a really good question. which is what do I do with my stocks heading into an earnings announcement? Very similar to what do I do with my trades heading into an economic report, a specific big economic report. And the biggest economic reports that I pay attention to, which I think we kind of call them the economic trinity, the big dogs, right? Wonder Woman, Batman, and Superman. We basically have the jobs data, which non-farm payrolls, which came out last week, which was kind of lukewarm again. We have GDP, which is the economy, and obviously we have inflation, right? All three of those are going to be heavily influencing what the Fed does with interest rates. Now, the numbers last week, the market reacted bullish, but they really weren't amazing to push us into new highs. So what does that kind of play into this week? Well, this week we have more inflation data. So we kind of work our way through what we have over here. If we kind of zip on over to the economic calendar and look at this week, this is the big dog we need to pay attention to. A lot of people right now are saying that PCE is the Fed's preferred inflation gauge, but CPI has been forever. I don't know how things changed just recently, but you need to know this heading into Thursday morning. So essentially what that means is that if you have swing trades going into Thursday morning, we need to assess our profitability and the risk that we're willing to take up till that moment. So in other words, we have all that information up to the point where I'm swing trading and I love the idea, all of that information, but now new information is coming out on Thursday morning pre-market. So that means good swing traders, which I know you are. You're up. If you're up right now with me at 7:30 in the morning, we're going over this. Good job. Is we have to now make a decision. Do I want to hold that swing trade into that economic report, which comes out 8:30, is scheduled for 8:30 on Thursday morning? So you need to make that decision Wednesday before the stock market closes. Now, a question that we get all the time is, how do I know what's my likely downside if it moves against you? Well, the first thing you need to think about is whether or not the stock is profitable or negative. So you're kind of putting yourself in a position, especially if it's negative, where you're hoping the market does you a favor. That's not a good position to be in, right? You like the idea, but new information is coming out. So you got to really think hard. Now, kind of an advanced thing that I just want to share with everybody. And this came up every Saturday. We have a Saturday swing trade session where we talk about stocks and options and the market and all those kinds of things. And we kind of broke this down on Saturday, which is kind of, I want to say it's advanced, but it's really kind of common sense, but probably not talked about enough, which is when you're in the stock market, if you're not sure about the idea anymore, but it's still valid, but for whatever reason, maybe new information is coming out, maybe a report's coming out, you don't necessarily need to get out of the whole thing. You can always scale back. And that's generally what I do. So if I have 1,000 shares and I'm kind of on the bubble of profitability, I'll take off 600. Still have the position on, but I don't like having myself in that position where the edge is gone and I still have full risk. So I want to be aware of that. I could get out, but I generally scale out because I still want to have it because I like the idea. I just don't love it as much because something new is coming out. So bringing that into Thursday morning and your profitability on swing trades. If you are slightly positive, you got a different decision now, right? So what most traders will normally do is you'll go over to the options market and you will look at the in-the-money strike price and go out to the next expiration and say, what is the options market expecting worst case scenario if this goes down at the next expiration, which is usually within the week. Now, I'm not talking about 0 day to expiration or anything along those lines, but take a look at the options chain for the stock that you own and say, okay, within now and the next expiration, which again is usually pretty close, what is the options market pricing in as volatility? And that will generally give you within a 68% confidence level where the market is anticipating it going. And that will help you make a decision on, are you okay with that volatility? Kind of an advanced topic, but you want to Google it. Use Perplexity, whatever you use for AI these days, and you'll find out that it's a relatively straightforward and, quite frankly, simple way to make a better informed decision about the stocks you bought into big economic data. So here's the big thing. I want to get back into the game plan for the week and give some ideas, right? So for the last few weeks, I pushed for you to have a list of stocks that you plan to trade for the next couple of next couple of months, regardless of the big picture trends. The earnings catalyst is one that we can rely on for opportunity. So let's be on top of that. So earnings season unfolding, it's been a very good play then we've been getting bullish gaps. They've been tending to follow through. Make that a part of your thought process right now. Add to the mix inflation data before the market opens on Thursday. And we should have a volatile week of price action. So again, wake up. The holiday's over. We should get some good trading this week, which means opportunity. Most of the big economic data the last couple of months has come in lukewarm. Actually, I spelled that wrong. That should be lukewarm. All right. No shocks to the system. One word. Which continue to open the door for the Fed to lower interest rates. So the Fed basically wants Goldilocks numbers right now, where it's not too high, where if it stays strong, then they have to leave interest rates up there, not too low, because then that would be a shock to the system, and then they'd be forced to panic, right? These kind of slow, gradual numbers are what the Fed wants, which is why we're kind of just slowly creeping higher, and then we go sideways for 10 days. So here's the stuff you need to know. If the CPI comes in higher than expected, we could see a volatile move lower. A slight decline wouldn't mean much, which is basically what we've been getting in those big three. A big decline would ignite a strong bullish reaction. So you need to have these if-then scenarios mapped out heading into Thursday morning, specifically by Wednesday afternoon, and say, okay, there's three potentials on the table. We've been kind of lucky with the way they've been coming out. What kind of risk do I want to take heading into that number? So I'm giving you 4 days, 3 days heads up to just think through your open swing trades. Now, I want to give some credit. I want to give some ideas. I want to give some credit. Brad on Saturday's coaching session pointed out the accumulation in Intel. This is one of those signs where you can see there's a downtrend followed by a long consolidation of price action. And then within that price action, heavy spikes of volume. That is typically quiet accumulation by the institutions picking up shares, and they have no reason to step up until they can no longer buy shares by advertising to buy. So in other words, there's two ways that we can always buy stock. We could just advertise and say, I'm going to bid at $30. If that selling pressure is still good, I can just continue to sit there and get the price that I want. Institutions have a little bit of a different situation. For them, it's more important to get the entire position on than it is to get the exact price. Obviously, if you know day trading, and have VWAP as an indicator, volume weighted average price, everybody knows that watching VWAP intraday is where most of the activity is happening. And again, I learned this from the specialist on the floor of the exchange. Most of the activity, they would like to see trade around VWAP, but certain periods of time, there is a heavier bid, which is aggressive buying. And if there's no selling, then they have to raise their bid. So I want to show you how that happens over time. This is actually something we discussed recently on a call as well. And you can see this a little bit more cleaner, where you can actually see, again, keeping an eye on earnings. Charter Communications had a big earnings gap, and they were able to fill, for whatever reason, down at that level, whatever reason they liked it at that level. But what's more important is they raised their bid. They raised their bid. They raised their bid. So I want to be really clear about this, and this is a big lesson for a lot of people to take. Stop looking for chart patterns. Chart patterns and predicting is not a way to make a living in the market. It is not a way to have that absolute conviction and see the consistency you want. If you doubt that for a second, go on Yahoo Finance and you will see, or just Google it, type in any stock, and the chances of you seeing the same stock being called one, buy it, it's amazing, it's going in the toilet. The odds of you seeing that for the same stock is really, really good. Learn to shadow the institutions by doing the work that I'm showing you right now. And again, obviously, I'm doing this for everybody in our community, and you will start to see stocks and charts in a completely different way. When you start to train yourself to say, those patterns that I was looking for predictions are actually real money being allocated to those ideas. When you start to see the charts as capital allocation, how long that allocation is happening, and then look for clues for when it's changing, everything changes in the stock market for you, because now you are no longer on the prediction cycle, which is really, really hard to get off of. And you're just basically saying, I know what I'm looking for. I know how much conviction is being spent to create that. And now I also know how to recognize if and when it's changing. So the clues that we're putting together right now is the market is still strong, but there are kind of cracks under the hood and big economic data this week. So I'm still looking to be a buyer this week, but not as aggressively until after some of this news comes out on Thursday and Friday. Okay, so let's continue to walk through what I'm kind of looking at for this week and give you some ideas. So summary of the three majors, right? New all-time highs on Friday. Again, all things seem to be rosy ahead of earnings season, but lurking beneath the hood are two things that stand out in our reach. Now, this is the first one that's really interesting. We just showed you this, right? So the other thing to pay attention to, which is here, all right? The VIX, the volatility index, while low, which is still around 12 or 13, rallied and closed near the high. That is unusual for a day when the market also closes at the high. So just to give you some context, the SPY made new highs and the VIX also rallied here on Friday. So to give you context of what that means, the VIX, the fear gauge, the volatility gauge for the S&P, basically moves in the opposite direction of the market. And when it's really low, volatility is low. We're not expecting a big move. So when the market goes up, the VIX technically should be going down or sideways. But on Friday, the market rallied and the VIX rallied. Now, that's likely options market makers positioning for volatility coming into this week, which is all the more reason to wake up. We should have a pretty good week of trading. So again, we're putting the clues together that lead to how much position size I am looking to start new positions. I will be looking to build on the ones, but we're talking now about starting a position and adding those pieces. If all of this stuff is new to you, by the way, watch the video again, take notes. One of the things that I wish I knew when I was a kid, especially when I was in high school, was I would read something and be like, this is overwhelming and I don't understand it. And then I'd leave it alone. We're talking about how to take money from the smartest people on Wall Street. Give you once, take notes, come back, ask questions, and you'll start to see that you notice more where it's the same charts. You're just noticing a little bit more. And again, if you want to do it with me, come into the Coaching Accelerator and join me for 2 weeks. You can just learn about that below in the video, in the description. So let's continue. I want to give you some ideas before we kind of wrap this up, which means we're going to head a little bit into sector rotation. So obviously technology is strong, but communication services is something that I've been keeping an eye on. So last week we initiated a new trade in Google. Again, following through at everything that we talked about. A stock is the right price until it's the right price and gets out of that. We don't do anything. Popped out, paused, and look for a new entry. So now we're working our way into what I just talked about. Where is institutional attention and where are they putting money? So we start working our way down into other ideas. Now, you should immediately, based on what we talked about before, be able to identify this is recent buying pressure in Roku, really strong move, but still testing that move to the downside, right? So if we were looking to trade Roku today after breaking out of that longer term trend, which is after 2 earnings reports, this would be very different from the Google trade, even though they're the same sector. One of them is breaking out, showing relative strength, would be a little bit more aggressive. This one is showing the first signs of stacked order flow. And even if we justified this trade, it would be lower initial position size. And we can kind of see how we work our way through some of the most recent ideas and what they mean for position size. So I'm just going to scroll through these. If you want, you could pause the video, go back and take a look at them. Charter is one of them. One of the ones we talked about, just kind of working our way back over to technology. Sometimes ideas can be as simple as possible. Technology stocks, semiconductor stocks kind of cooled off a little bit. AMD finally broke this trend line. We talked about it, I think, 3 times last week where I said, keep it simple, keep it simple. The stock has kind of been in the doghouse, has not shown relative strength. It broke out last week. So another stock that we're looking to start to build a position. Now, I want to be clear about this because every time I talk about stocks, we always get somebody in the chat saying, you lost money on that idea. Okay, that's fine. It's a business expense. When you have a loss on a stock, it's a business expense. Get that in your mind. It's not bad. It's not anything. It's you took an idea, put some money on the line because you thought it was a good idea. If it makes money, great. We'll make money on it. If it doesn't make money, you're paying a business expense. We write this down. A trading loss is a business expense. And when you wrap that around your head, it makes it a lot easier to run a trading business because now it's not a personal assault to your ability as a trader. So all of these ideas that I'm talking about now, you should immediately be able to say, how strong of an argument is it? How much stacked order flow, which means how much money was allocated already before I look to buy that stock? Basically, is smart money building a position? Yes or no? How long has smart money been building a position? A couple of days, 5 days, 5 weeks. That should indicate how much conviction we should have because we're basically shadowing the conviction that they have. If it's established, we can be a little bit more aggressive with initial position size. If it's just starting, like we just showed you here, that would be lower initial position size, looking for more order flow to follow up. And again, we got a couple of more ideas here. Obviously, this one, Cuervo, is not broken out yet, but you can actually see Z-scaler. So there's a bunch of them that we're looking at right now. And if you want, obviously, you can now rewatch the video and then take a look at those ideas yourself. So we have a ton of stuff going on this week. Obviously, the inflation data coming out on Thursday. Think through what we talked about. Look at the options market, determine where they are expecting the volatility, and help you make the decision on whether or not you want to hang on to that heading into Thursday morning's economic data. Then we have the banks kicking off. My gosh, have a good cup of coffee this week and be ready to trade. Earnings season's kicking off. We have all of that information from the market internals that I just showed you. So to super dial this back in, I am still a buyer this week, but we're showing signs of the market not being perfect. Most of the buying pressure is in those 4 or 5 large cap tech stocks. As of right now, that's good. We're still following it. But if that starts to turn a little bit more neutral and we don't see other sectors picking up the slack, then I'm going to dial it back even more. Remember, we don't have to be aggressive all the time. We have to be aggressive at the right moment. The one sector that is perking up just a little bit right now, communication services, and we just saw energy and a couple of energy stocks that look pretty good. It died on Friday, but we're still keeping an eye on it. All right. So if you have any questions, obviously leave a comment below the video. I would love to hear from you. If we did a good job, do me a favor, give us a thumbs up and click subscribe. And if you want to join me for the 2-week coaching accelerator, click that link in the description. I'd love to see you on the other side. I do the personal coaching. So if you have any questions, I'd love to speak to you as well. All right. Have an awesome week. Should be great volatility. Thank you so much for joining me. I'll speak to you soon.